Have you ever looked at a financial chart and it just seems like a total jumble of red and green lines? Yeah, it can feel a bit like you're trying to read a foreign language. But what if I told you that it is a language? It's the language of the market, and it tells this incredible visual story of the battle between buyers and sellers. And today, we're going to learn how to read it. We'll start with the very basics and build up from there. So let's just dive right in.
So when you look at a chart like this, it's really easy to feel overwhelmed. I get it. But every single one of those little bars, every candle, it's a piece of information. It's a clue to what traders were thinking and feeling in that very specific moment. So the goal here is to give you the tools to decode that story, one candle at a time.
All right, let's start with the absolute basics. Think of this as the alphabet of our new language. This is a single candlestick. Now, that thick part in the middle, that's called the body. It tells us where the price opened and where it closed for a certain period of time. And those thin lines sticking out, the wicks, they show us the highest and the lowest points the price traveled to before it settled. It's this neat little package of 4 key data points: the open, the close, the high, and the low. All of that info packed right into one simple shape. Now, let's talk about color, because this tells a really simple but important part of the story. If the candle is green, it just means the price closed higher than it opened. Buyers were in control. We call this bullish. If it's red, well, the price closed lower than it opened. That means sellers were in control, and we call that bearish. Green for up, red for down. Super simple, right?
Okay, so we've learned our letters. Now it's time to start forming some words. See, when you put a few of these candlesticks together, they can form patterns. And these patterns, they tell us these fascinating little stories about market psychology, stories of indecision, rejection, and huge shifts in power.
Our first word is the doji. Think of the doji as the market just taking a deep breath, kind of pausing and saying, I'm not really sure which way to go next. It's this powerful visual of a stalemate, a moment of almost perfect balance in that constant tug of war. And that indecision, that's a crucial piece of information for us.
Visually, a doji looks like a cross, and that's because the open and close prices are pretty much identical. The bulls tried to push the price up, and the bears pushed it all the way back down. By the end of the period, they've basically fought to a draw. Neither side could get control, and that moment of pure indecision can often signal that a change might be just around the corner.
So here's the crucial part: how you read it. When you see a doji pop up after a strong trend, either up or down, it's like a little warning sign that the trend might be running out of gas. But, and this is a big but, the doji itself isn't a signal to act. You always have to wait and see what the next candle does. That next candle is the confirmation. It's what tells you which way the story might go next.
Let's move on to our next pattern and see how these stories build. This one's called the hammer, and it tells a fantastic story of rejection. It's all about sellers trying to push the price way, way down, but then the buyers just storm back in with incredible force.
You can spot a hammer by its really distinct shape. It's got a small body up top with a very long lower wick. And that long wick is the whole story. It shows that sellers tried to take over, but a whole floor of buyers stepped in and basically said, nope, the price is not going any lower. That rejection, it's a huge sign of strength. It's a powerful shift in mood, especially after a downtrend.
So how might someone actually use this? Well, first, you're looking for it at the end of a downtrend. Then, just like with the doji, you wait for confirmation, usually a strong green candle right after it. A pretty common strategy is to consider entering a trade if the price moves above the highest point of that hammer candle.
Our final pattern for today is one of the most powerful ones out there. The engulfing pattern isn't just a story of a fight, it's the story of a complete takeover. It's a really dramatic shift in power from one side to the other. And there are 2 versions of it. A bullish engulfing happens after a downtrend. It's when a big green candle completely dwarfs, or, engulfs, the previous small red one. It's like the buyers just stepped in and totally erased the seller's effort. And the opposite is a bearish engulfing, after an uptrend, where a huge red candle just swallows up a smaller green one. It's a very, very strong signal that the trend might be over.
All right, so we've learned a few key words, but just like in any language, just knowing the words isn't enough. You have to understand the grammar and the context to actually form coherent sentences and understand what's really being said.
And these are the essential rules of grammar. First off, context is king. A pattern that shows up at a really significant price level, like a previous high or low, is way more powerful. Second, look at the volume.
Think of volume as the amount of conviction behind a move. A pattern that forms with high trading volume is much more reliable. And as we've said, and I'll say it again, always wait for confirmation from the next candle. And finally, always have a plan to manage your risk, like knowing where you'll get out if the trade goes against you. Following these rules is what separates analysis from just guessing.
Which brings us to the mistakes that, let's be honest, everyone makes at the beginning. The biggest one? Seeing a pattern and immediately jumping into a trade without thinking about the bigger picture. Don't trade every single hammer you see. Don't ignore the overall trend. And please don't forget about confirmation and context. Trust me, these mistakes can be really costly.
This is the big question, isn't it? I mean, learning any new skill takes practice, but when you're dealing with the market, practice can be expensive. So how do you build that experience and that confidence without risking your hard-earned money?
Well, the consensus among pretty much all experienced traders is that there's just no substitute for screen time. The best way to learn is by doing, by seeing these patterns play out for yourself, but doing it in a safe environment. It's all about building confidence through real experience, not just reading it in a book.
And that is exactly where practice accounts or paper trading simulators are just invaluable. A lot of platforms and apps offer these for free. They let you take everything we've just talked about, apply it to real-time charts, and see the results without risking a single penny. It's the perfect training ground to practice reading the market's language and really hone your skills.
So there you have it. You've got the alphabet, a few keywords, and the basic grammar of candlestick charts. You now have the foundation to actually start decoding the market story. The only question left is, are you ready to start the conversation?